4,700. Hold that number in your mind. It is April 2026, and an ounce of gold is no longer trading at the prices they taught you in business school. It has doubled. It has exploded. And while the skyscrapers in London and Toronto are counting their projected billions, a young captain in Ouagadougou just picked up a calculator. They tried to kill Ibrahim Traoré for what he is doing right now. They called it instability. They called it risk. But the numbers tell a different story, a story of a systematic theft that has lasted for 60 years. 10 days ago, the Kyaka decree hit the desk of every mining CEO on Earth. Burkina Faso didn't ask for permission. They didn't beg for a loan. They simply took back 25% of their own soil for a price that makes the West tremble. This isn't just about Burkina Faso. From the military helicopters seizing gold in Mali to the strict deadlines issued by the regulators in Ghana, the arithmetic of Africa is being rewritten in real time. The era of the 85% foreign profit is dead. Today, we go beyond the headlines. We follow the money. We reveal the sovereign discount and the secret math that the extractive legacy system prayed you would never understand. By the end of this video, you will realize why the West is silent, why the mining giants are staying despite the heat, and who the next domino to fall will be. Africa is not asking for its share anymore. Africa is taking the whole table. The arithmetic of theft is always silent. It lives in the fine print of contracts signed in dimly lit rooms, decades before the people of Burkina Faso decided to reclaim their destiny. For 60 years, the extractive colonial legacy has operated on a simple, brutal formula. Africa provides the soil, the sweat, and the gold, while the offshore accounts in Toronto and Perth provide the vacuum. But on April 12, 2026, the vacuum hit a wall. Captain Ibrahim Traoré didn't just sign a decree. He performed a surgical extraction on the system itself. The Kyaka gold mine, a 54 square kilometer scar of immense wealth in the Center-East region, was the target. Operated by West African Resources, an Australian-listed entity, Kyaka was projected to be a crown jewel of the foreign extraction machine. In the first quarter of 2026 alone, it pulled over 65,000 ounces of gold from the earth. At $4,700 per ounce, that is not just mining. That is a minting press. According to the official decree, the Burkina Faso state, through its sovereign vehicle, Supreme Sa, acquired 25% of Kyaka for $125 million. To the uninitiated, this sounds like a standard transaction. To the architects of the old world order, it was a declaration of war. Why? Because the math doesn't add up for the corporations anymore. Let's look at the sovereign discount. Based on previous market valuations, a 25% stake in a mine of this caliber should have cost the state at least $167 million. Traoré took it for $125. That is a $42 million gap, a penalty for decades of lopsided profits. But the purchase price is a distraction. The real story is the yield. At current 2026 prices, that 25% stake will return approximately $300 million every single year to the people of Burkina Faso. The government paid once. They will collect for 20 years. They spent $125 million to secure $6 billion in lifetime value. That is the secret math they tried to hide. The Western analysts call it arbitrary. They call it forced participation. But records indicate that the mining giants are not leaving. Richard Hyde, the CEO of West African Resources, didn't pack his bags and flee to Australia. Instead, he confirmed the transition and promised a special dividend to his shareholders. The reason is simple. Greed has met its match in geography. Even at 60% ownership, Kyaka is so profitable at $4,700 an ounce that the company would rather take a seat at the back of the bus than be kicked off the bus entirely. The geology of the Sahel is too rich to abandon, and the captain knows it. This move wasn't an isolated event. It was the culmination of a structural siege. In 2024, the mining code was rewritten. In 2025, the National Gold Refinery was commissioned. Traoré didn't just seize a mine. He built the cage first. Then he invited the giants inside. The system thought they could wait him out. They thought if they squeezed the credit, the captain would fold. They were wrong. By securing direct equity, Burkina Faso is no longer a passive spectator collecting a 5% royalty check. They are now the board of directors, but as the ink was drying on the Kyaka decree, a shadow began to fall over the other giants in the region. Because if Kyaka can be taken for a discount, what does that mean for the billions of dollars sitting in the Northeast? The giants are beginning to realize that the rules of the game have changed forever, and the man with the calculator isn't done yet. The Kyaka decree was a shock, but it was only the appetizer. While the mining boardrooms were debating the sovereign discount, a message was sent across the border to Mali. They thought legal arbitration would save them. They thought the shadow architecture of international law could protect their hoard. But $42 million in discounts is nothing compared to what happens when the direct action begins. Records indicate that when the largest gold company on earth refused to pay, the response wasn't a letter, it was a military helicopter. Stay with us, because the secret math is about to turn into a secret raid. The boardrooms in London and Toronto always believed in a specific kind of gravity. They believed that if an African nation dared to touch their profits, the weight of international law, credit ratings, and Western sanctions would pull that nation back to earth. They thought they were untouchable. Then came Mali. Under the leadership of Colonel Assimi Goïta, the Malian state decided to stop playing by the rules of the extractive colonial legacy. In 2023, they didn't just ask for a better deal, they tore up the old one. They revised the mining code, raising royalties and demanding that the state own a massive piece of every ounce pulled from Malian soil. Most companies grumbled and complied, but Barrick Gold, one of the largest gold mining entities on the planet, decided to resist. Their Loulo-Gounkoto complex was a fortress of profit, accounting for 15% of Barrick's global output and nearly $900 million in annual revenue. They thought they were too big to fail. They thought Mali needed them more than they needed Mali. They were wrong. In January 2025, the silence of the desert was broken. Malian authorities didn't send a legal brief. They sent a clear signal. Operations at Loulo-Gounkoto were suspended. An arrest warrant was issued for the former CEO. 4 senior employees were detained. And then, the image that sent shockwaves through every stock exchange in the West. A military helicopter descending on the mine site. According to reviewed reports, the Malian military seized approximately 3 metric tons of physical gold. They didn't wait for a court order from Paris. They didn't ask for permission from the World Bank. They took 3 tons of gold valued at $400 million and transported it directly to a state-controlled bank in Bamako. For nearly a year, Barrick Gold was locked out of its own operation. One of the most powerful corporations in the world was reduced to a spectator, watching from the sidelines as a provisional administration took control of their billion-dollar asset. The extractive framework tried to fight back. They threatened international arbitration. They warned of a total exit of foreign capital. But the Malian government remained unmoved. Their logic was simple. The gold is in our ground, the workers are our people, and the law is our sovereignty. If you want to mine, you pay. If you want to resist, you leave. The resolution came in November 2025, and it was a total capitulation. Barrick Gold agreed to pay a settlement of $430 million. They dropped all international claims. They accepted the new, higher royalty terms of the revised mining code. They paid nearly $500 million just for the privilege of staying in the room. This was not just a legal victory, it was a demonstration of power. In March 2026, President Goïta took the victory a step further. He didn't hide the money in offshore accounts. He presided over a public ceremony where $33 million of that mining revenue was distributed directly to local mining development funds. For the first time in generations, the people living above the gold could actually see the wealth it produced. But Mali's masterstroke wasn't just about seizing gold. It was about the refinery strategy. While the West was focused on the settlement, Bamako was building the Soromasa gold refinery with Russia's Shadran Group, a capacity of 200 tons per year. 62% state-controlled. Records indicate that this refinery changes everything. When a nation refines its own gold to international standards, it breaks the final chain of the colonial legacy system. They no longer need to route their wealth through Swiss vaults or Western intermediaries. They can sell directly to China, to Russia, or the UAE, This is what the secret math looks like when it is enforced by a sovereign military. It is the shift from being a host country to being a owner nation. The message to the giants in London was unmistakable. The direct action in Mali has set a precedent that cannot be ignored. The shadow architecture of the past is crumbling, and the new arithmetic is being written in gold and steel. But the most terrifying realization for the mining executives wasn't what happened in the Sahel. It was what happened next in the country they thought was their safest ally. Mali proved that the military could enforce the math. But the global markets told themselves it was an anomaly, a Sahel phenomenon, born of revolution. They believed the rest of the continent would remain stable and compliant. They were looking the wrong way. 3 days ago, the largest gold producer in Africa, a nation that didn't exit ECOWAS, a nation the West calls a model of democracy, just issued an ultimatum that makes Traoré's decree look like a suggestion. Ghana has entered the fight, and they've given the giants exactly 8 months to hand over the keys or lose everything. The extractive colonial legacy had a favorite shield, the Sahel exception. Whenever Traoré signed a decree or Goïta seized a mine, the boardrooms in London and Paris would whisper to their investors that this was merely a regional glitch. They claimed it was a byproduct of military rule, a temporary fever that would never cross into the stable and compliant economies of West Africa. On April 22, 2026, that shield shattered. Ghana, the continent's largest gold producer, the darling of Western financial institutions, and a nation that has stayed firmly within the traditional diplomatic fold, issued a notification that sent the mining giants into a blind panic. The Ghana Minerals Commission didn't just ask for better royalties. They issued an ultimatum to 3 of the biggest names in global mining: Newmont, AngloGold Ashanti, and the Chinese-owned Zijin. The order was simple. The order was final. Transition all mining operations to local Ghanaian contractors by December 2026, or get out. According to official regulatory filings, surface mining must now be conducted by companies with 100% Ghanaian ownership. Underground mining, at least 50% local equity. No extensions, no exceptions. This is the secret math manifesting as a regulatory guillotine. Newmont's global CEO reportedly rushed to Accra this month, desperate to push the deadline to 2027. He was met with a cold refusal. The Mineral Commission pointed to the Damang mine previously operated by Goldfields, which has already been successfully transferred to a local firm, engineers and planners. The precedent exists, the local capacity is ready. The era of the foreign intermediary is ending even in the places the West thought were safe. But why now? Why is Ghana, a country that hasn't exited ECOWAS or joined the A's, suddenly moving in lockstep with Traoré? The answer is the arithmetic of $4,700. When gold prices double, the cost of being compliant with the old world order becomes an existential threat to the nation. Ghana is watching tens of billions of dollars in value leave its shores while its own currency struggles. The government realized that stability was just another word for a cage. Records indicate a growing tension, however. The extractive framework is trying to use labor as a weapon. Reports suggest that mine workers under local contractors are being paid significantly less than they were under the multinationals. This is the last card the old system has to play, trying to convince the African worker that their own countrymen are worse masters than the foreign ones. The Mineral Commission has responded by tightening oversight to prevent wage erosion, but the battle lines are drawn. This is no longer just about who owns the gold. It is about who owns the entire architecture of labor and profit. The Ghana contagion proves that the shift towards sovereignty is not a political ideology, it is an economic necessity. Whether you are a revolutionary in a red beret or a regulator in a business suit, the math leads to the same conclusion. You cannot look your citizens in the eye while 85% of the wealth under their feet belongs to a company in Toronto. The mask has slipped for the entire continent. If Ghana can do it, who can stop Tanzania? Who can stop Nigeria? Who can stop Guinea? The giants are looking at their maps, and for the first time in a century, they don't see stable partners. They see a continent that has finally learned how to use a calculator. But as the panic spreads to the boardrooms, Traoré is already looking at his next target, a target so large it makes Kyaka look like a sandbox. Ghana has proven that the contagion is continental. But while the headlines are focused on the regulators in Accra, the secret math is being applied to the biggest prize of all. Deep in the northeast of Burkina Faso lies a monster, a mine producing over 400,000 ounces of gold every single year. At $4,700 an ounce, this single site is worth more than $2 billion in annual revenue. Currently, 85% of that wealth belongs to a single Canadian firm. But if you look closely at the Kyaka decree, you will see a pattern that suggests this $2 billion giant is the next domino to fall, and the countdown has already begun. The boardrooms of Toronto and London are no longer discussing if the next nationalization will happen. They are discussing when. Because the arithmetic of Ibrahim Traoré is not just a policy, it is a hunting pattern. First, he rewrites the mining code. Then he builds a national refinery. Then he takes a smaller mine as a test case. Kyaka was the test case. Now, the hunters are looking at the crown jewels. According to reviewed geological data, the single largest target in Burkina Faso is the Esakane mine. Located in the northeast, near the border with Mali and Niger, Esakane is not just a mine. It is a golden engine that powers an entire corporate empire. It produces between 400,000 and 440,000 ounces of gold every single year. At the April 2026 price of $4,700 per ounce, Esakane is pulling over $2 billion out of the ground annually. $2 billion from one single site. Currently, the Canadian giant IAMGOLD holds an 85% stake in this operation. The Burkina Faso state, a mere 15%. In the old world, this was considered a partnership. In the new arithmetic of the Sahel, it is considered an absurdity. The secret math suggests that if Traore applies the Kyaka formula to Esakane, moving the state stake from 15% to 40%, he would capture an additional $500 million in annual revenue for the treasury. That is $500 million every year from one adjustment. The extractive framework is terrified. They have seen the captain's playbook. They know that in June 2025, the state already raised its stake from 10 to 15%. It was a warning shot, but back then, gold wasn't at $4,700. The stakes were lower, the air was cooler. Now, the heat is unbearable. Records indicate that IAMGOLD is trying to play a high-stakes game of essentialism. They have committed $165 million in new investments for 2026. They are stripping waste, developing new pits, and replacing heavy equipment. They are betting that if they make themselves indispensable through technical complexity, the state won't dare to intervene. They are wrong. They are forgetting the Mali precedent. Barrick Gold was also essential. They also had technical complexity. They also had billion-dollar investments. And yet, when the state decided to act, the technicality of the mine didn't stop the military helicopter. The geology belongs to the people. And the people have realized that technical expertise can be hired. But sovereignty must be taken. And IAMGOLD is not the only domino wobbling. Just 85 kilometers east of the capital, the Bombor mine operated by Horizon Gold is ramping up production. They just commissioned a new $80 million plant. They are targeting 250,000 ounces per year. Like Esakane, the state currently holds only 15%. The mining executives are whispering the word yet. The government hasn't demanded more. Yet. In the current geopolitical climate. Yet is the most expensive word in the English language. It represents the ticking clock of a dying system. The old world order is trying to pivot. They are trying to find safe partners. They look at the fact that Traore recently granted a license to Russia's Nord Gold, and they claim it as just a swap of masters. But the numbers tell a different story. The Russian deals are being signed under the new 2024 mining code with higher royalties, local content requirements, and state participation that the Western giants spent decades trying to avoid. The choice for the foreign operator is now binary. Accept the new arithmetic and stay, or fight the math and lose everything. The sovereign discount we saw at Kyaka, that $42 million penalty, was just the opening bid. For a monster like Esakane, the discount won't be measured in millions. It will be measured in the total restructuring of how wealth flows across the Atlantic. The giants thought they were mining gold. They didn't realize they were mining the very floor they were standing on. And now, the floor is gone. As we look toward the final balance sheet of 2026, the question is no longer about one mine or one country. It is about a continental awakening that has finally realized its own worth. The era of the beggar nation is over. The era of the owner nation has begun. But there is one final calculation we must make. A calculation that involves $14 billion and a promise made 40 years ago in a speech that cost a man his life. Numbers have a strange way of stripping away the lies of history. For decades, the official narrative of the old world order told us that Africa was a burden, a continent of aid, debt, and underdevelopment. They told us we needed their experts to dig our soil and their banks to hold our wealth. The arithmetic of 2026 has proven that the opposite is true. Burkina Faso's gold sector alone produced 94 metric tons in 2025. At today's price of $4,700 per ounce, that is over $14 billion of wealth generated by a single nation in a single year. When you add Mali and Ghana to the equation, the gold leaving West African soil is measured in the tens of billions. The West is not aiding Africa. Africa is subsidizing the West. Ibrahim Traoré understood this truth. He understood that you cannot build a nation on the crumbs of a 5% royalty. He understood that the extractive colonial legacy only survives as long as the host remains asleep. But as the Kyaka decree proves, and as the military helicopters in Mali demonstrate, the host has finally opened its eyes. The secret math is no longer a secret. It is a blueprint. Every time a mining CEO signs a new agreement in Ouagadougou, every time a regulator in Accra refuses an extension to a multinational, the shadow architecture of the past grows weaker. They called it stability when they were taking 85%. They call it chaos. Now that we are taking it back. But look at the results. The revenue from Mali's mines is flowing directly into local development funds. Burkina Faso is building its own refineries. Ghana is empowering its own contractors. The choice is no longer between foreign investment and poverty. The choice is between servitude and sovereignty. 40 years ago, Thomas Sankara warned us that those who feed you also control you. They eliminated him because his arithmetic was dangerous to the system. Today, Ibrahim Traoré is finishing what Sankara started, but he is doing it with a calculator in one hand and the sovereign will of a continent in the other. The giants in Toronto and London can keep their shareholders' meetings and their stock exchange halts. Africa is moving on. The era of the passive royalty is dead. The era of the owner nation has arrived. The gold has always been ours. The wealth has always been ours. Now finally, the math is ours too. The question is no longer whether we can afford to be free. The question is how the world will survive once it can no longer steal from us. This is the awakening. This is the new Africa. And this time, we are not asking for a seat at the table. We are taking the whole table. The arithmetic doesn't lie, and the numbers are finally in our favor. If this video changed how you see the wealth of our soil, hit that like button to show the algorithm that the truth cannot be suppressed. Share this with one person who still believes Africa is poor. Let them see the $14 billion reality. Drop Africa Rise in the comments if you believe the era of the 85% theft is over. We are reading every single one. And if you haven't already, subscribe to join the front lines of this geopolitical shift.